If you're new to commercial real estate and looking to buy your first commercial property, by the end of this video, you should feel comfortable putting in your first offer. Commercial real estate is not easy, but it is very simple when you break it down in a step-by-step process. And today, I'm gonna show you how to find these deals, how to analyze them properly, how to put the money together so you don't have to use your own capital. We're gonna be diving into everything, so definitely save this and come back to it as needed. Whether you're looking at office, retail, industrial, multifamily, hospitality, doesn't matter. We're gonna be breaking it down. Let's dive on into it. Chances are good if you are new to commercial real estate in general, you've probably either invested in residential real estate or have considered doing it in the past. There are many reasons as to why commercial real estate is actually better than residential in my opinion. Up first, we have the income potential. Most houses today, single family homes, you are lucky to be making $100 to $200 in passive cash flow per month, which, let's be honest, if you have an HVAC unit, go out on your property, and I know because I just replaced mine at my own house, it was $6,000. Even if I was netting $500 a month on a single family home, that is my profit for the entire year. However, commercial real estate, since it's bigger, you have higher income potential. Little instances like that don't actually affect your cash flow all that much, and you can pretty easily absorb it. Commercial properties are also so much better for diversification of your investment portfolio. You have a single family home and you lose a tenant, they move out, which tends to happen every year or so, then you have 100% vacancy, which means you have no income coming in on that asset. Whereas in commercial, it is very typical for you to have multiple tenants paying you rent each month, which means if you lose one, you'll notice it, but it's not gonna be as big of a hit. You're not gonna have to start paying your mortgage, hopefully. So that is why I always recommend commercial over residential, because the diversification alone is way better for your investment strategies. Commercial real estate also has far better appreciation. We'll talk about this more in the video today, but forced appreciation is something that you can take advantage of in commercial real estate that does not exist in the residential world. Think about it. In residential real estate, you are typically renovating your properties to the comps within your neighborhood. So if your neighbor's house only sold for $200,000, you're probably not going to be able to sell your house for much more than $200,000. Whereas in commercial real estate, the properties are valued based on the income that is brought in from the lease, and they use cap rates to determine that value. That's how I bought a $435,000 property here in East Nashville, signed a lease before we closed, and had it appraised for $650,000. That's forced appreciation. So overall, commercial properties are just far more stable when it comes to your investments. You might argue, well, how do they perform in economic downturns? Tyler, look at office space in San Francisco. And yes, I hear you on that. But overall, you have professional tenants that want to keep their businesses open because that's how they make money. They're going to take care of your spaces better than residential tenants ever will. And honestly, it's just better for your own sanity and mental health to be dealing with businesses instead of people. All right, now let's get into the studio and dive into which properties you should be looking at as a beginner commercial real estate investor. And I forgot to tell you while we were outside that if you stick around to the end of this video, I'm going to give you a QR code to download my ultimate deal analysis toolkit. It's got my underwriting spreadsheet, which is $200. I actually sell that on my website. I'm gonna give it to you for free, along with a couple of checklists and some other items so that you can utilize that as you are going through this process of buying your first property. But you're probably thinking, what type of deal should I buy? What kind of properties should I be going after? Which commercial real estate is gonna make me a millionaire or bring in $10,000 a month in passive income? And I gotta be honest with you, I'm gonna give you the typical commercial real estate investor's response: it depends. I know that that's not really the greatest answer in the world, but here's the thing. Whether it's office, retail, industrial, multifamily, hotels, hospitality, doesn't matter. You can do incredibly well in any of these asset classes. I personally don't care for multifamily. I don't think that the returns are really worth it there today. However, there are investors out there that are making millions of dollars doing multifamily deals right at this very moment. Same for self-storage facilities and flex development. It doesn't really matter. What does matter is your commitment and your consistency in making it happen. So you should go ahead and pick one, which one sounds the best to you, and then go ahead and commit to being consistent on looking at those deals, underwriting those deals. Underwrite a deal a day. Just go through it. Be consistent with that. But if I had to pick three, because I know you guys are going to nail me down in the comments and say, yeah, but, then I would say outdoor self-storage is a phenomenal first type of commercial real estate for beginners because it's relatively easy to manage. It's relatively inexpensive compared to other commercial properties to build ground up if that's what you're planning on doing, or to just buy existing for the amount of units and income that you can get. I also love multi-tenant strip centers because who doesn't love retail, especially the right type of retail? Those businesses are doing great today, and they have a favorable lease structure for new commercial real estate investors, which is called the triple net lease. Check out this video here if you want to dive further into what that actually means. But at the end of the day, the tenants are fully responsible for all of the expenses on the property, or at least most of them. So you don't have to worry about that as a commercial real estate investor. And then last but not least, flex space. Flex space is basically a little bit of office with a little bit of warehouse, and it is a flexible space for most types of businesses to occupy. It could be your local HVAC technician or a podcasting studio. They can accommodate a wide variety of tenants, which makes them very easy for first-time investors that are unsure about how to find businesses to occupy their spaces, but also they're very in demand. A lot of these flex spaces have been torn down because they're closer to the urban core where there's a higher and better use, meaning they're building apartment complexes there, or climate-controlled self-storage, or new office buildings, whatever it is. The supply is dwindling and the demand is increasing. That's always a good market to be in. The value-add strategy is my primary investment strategy when it comes to commercial real estate. I mean, let's take a look at a deal that I did. Travis Drive, this was an older office building, 2 stories, 12,000 square feet, totally vacant. Nobody is gonna lease that for their entire company. That's kind of how it was set up. It was just one big office space up on the top floor and then 5 smaller offices on the ground floor. In that area, nobody was gonna rent 6,000 square feet all at once. So we looked at it and we thought, how can we add some value to this property? Well, we ended up cutting the upstairs from 1 office suite into 12 micro suites with a shared kitchen, shared restrooms, shared signage. We kept the downstairs as 5 individual suites, repainted the building, redid the parking lot, added a little island and some signage out front to really separate it from the road, improved all of the interiors. And here's how effective that strategy can be. I did all of that construction, spent all of that money, and delivered the property in January of 2020, 2 months before the COVID shutdowns. Now, despite all of the work from home mandates, despite all of the fear and everything that was going on because of COVID, we signed 17 leases and had that building sold that October of 2020 for $1,650,000, which was $400,000 more than what I had put into the building because we had come in, added value, signed some leases, and made it very valuable to the next investor. So I mentioned earlier with increasing your net operating income by either decreasing your operating expenses or increasing your rental income. And that's one of the first ways that we're going to talk about analyzing commercial real estate deals, because your NOI really determines what the value is. So what is your NOI, or net operating income? Well, it's really your gross revenue. So all of your rental income minus any expenses on the property before your debt service. That is your net operating income. So let's walk through an example of how this might look. Let's say you've got a property with a gross rental income of $100,000 a year. You've got debt service of $50,000 a year, and you have operating expenses of $25,000 a year. Since we're calculating the net operating income, we're actually going to completely ignore the debt service. So it's $100,000 minus $25,000, which gives you a $75,000 a year net operating income. Now you can see there's a couple of ways that we can increase that. Either we increase our gross revenues or we decrease our operating expenses. And here's why this actually determines what the value of a commercial property is. It's because commercial properties are treated like true investments. Investors are buying the income that that property produces, which means that they are going to pay you more for a more stable property that they don't necessarily have to mess with. And every dollar of rental income just multiplies based on the cap rate that people are willing to pay. Now let me show you how cap rates work. So a cap rate is really the cash on cash return that you would get if you paid all cash for a property. So $75,000 at a 7% cap rate gives you a value of $1,071,000. However, if we save $5,000 on our operating expenses, and now we have a net operating income of $80,000, at the same 7% cap rate, that property is now worth $1,142,000, which is over $70,000 in value just from $5,000 in savings. That's why forced appreciation is so powerful in commercial real estate, and why I would never touch another residential deal ever again. So look, we can get really into the weeds here on how to properly analyze commercial real estate deals. There's entire college courses, online courses, seminars, whatever, on how to properly do this. I'm not gonna have time for this video. Check out this one here to really dive into it. However, what you need to know, just for simplification, is look at the total price of the property, divide it by the square footage of that property, and then multiply that by 10%. That is going to give you the triple net rental rate that you will have to achieve on a price per square foot basis for that property. If that rental rate checks out with what is being asked in your market, you're good to go. If it is way higher than what anything else is, I would probably pass on that deal. It's not even worth analyzing any further. So if you found a deal and you've analyzed it and it looks like it's going to work from you, what are the next steps? Well, in commercial real estate, you don't just submit a National Association of Realtors purchase and sale agreement form. There's a bit more of a process here, and that involves a letter of intent. Now, the letter of intent is something that you or your broker can work on by yourselves, but I do recommend that once you get to the purchase and sale agreement point of these negotiations, get a commercial real estate attorney, get somebody in there that knows what they're doing, especially if this is your first deal. There's so much that you don't know. You don't know what you don't know. So make sure that you're at least taking the proper processes, protecting yourself the right way, and getting legal help as you're diving into this. So let's say that you're pretty confident that your letter of intent is going to get accepted, or you're already trading purchase and sale agreements. That's when you're going to start working on your full underwriting. Now, that's not to say that you probably shouldn't start working on this a little bit earlier in the process, but you're not going to know what the final terms of the deal are until you have an executed agreement. You may not necessarily agree on what the purchase price is, which could totally change all of your underwriting. Now, you can run through scenarios, but at this point is when you can really start to nail down what the numbers are going to look like on that opportunity. Now, underwriting can be very intense. You have to know what the purchase price of the property is, what the rental income could potentially be, any operating expenses, what your debt and debt service is going to be. And fortunately, that is all going to be calculated and handled for you in the underwriting spreadsheet that I'm going to give you at the end of this video. It's very simple to just follow the step-by-steps in the underwriting spreadsheet. Dive into this video here where I tell you all about utilizing that spreadsheet so that you can learn how to properly underwrite your deals. What's a good return on commercial real estate investments? The problem is, with that question, it's way too subjective, because it completely depends on you, your financial situation, and what returns you have to get for yourself personally. You may be happy with 5% cash on cash returns and buying single tenant net lease Walgreens deals because you don't have to lift a finger and deal with it whatsoever, and you're enjoying the tax benefits that you're getting as well. We have a lot of high net worth individuals that work with us that are able to save more money by not paying taxes due to the depreciation on their real estate than they will ever make in cash flow from their assets. You may be wanting to get to $10,000 a month in passive income. And if that's the case, you're gonna wanna go with value add opportunities to where you can get somewhere between 10, 15, 20% cash on cash returns. That is entirely possible. We have plenty of deals that I have done where we have gotten well over 20% annualized cash on cash returns. However, it's not easy to do. So for your first deal, go for 8%. If a deal works at an 8% cash on cash return, it's probably a good first project for you to be working on, and it's gonna be better than the stock market. Does the stock market average higher than 8% cash on cash returns? Yes, but the stock market also doesn't have all of the tax benefits and everything else that comes with owning real estate. All right, so how do you actually fund these deals? Where does the money come from? How can you structure it? If you don't have capital, if you're buying your first commercial property, you probably don't have any money. But the great news is you don't actually have to have your own money to get these things started. You can get creative with your financing. That means that either you can go raise equity from other investors to invest in your deal with you, or you could actually negotiate something creative with the seller, right? You could come in, you could joint venture with them so that they are actually your partner. They're contributing the property to whatever development, redevelopment, value add project you're going to do. You can also structure it with seller financing, so you don't even need to bring a bank to the table. You just use them as the bank, right? And there's a lot of benefits for property owners to do deals with you like this because they're going to make more money if they structure it in a way like this. But if you're looking to raise capital from typical investors, you should be raising capital yesterday. No, you may not necessarily have a deal, but it should be, hey, by the way, I am getting into commercial real estate. I'm going to be raising capital for these deals. Here's the types of returns that I'm looking to give to my investors. Here's the types of projects that I'm interested in doing. Is that something that you would be interested in partnering with me on if I could get you the returns that you need? Do that all the time. I've had mentors that's all they do is everybody they come across, they let them know. And I've done the same thing in my career. Hey, by the way, I'm in commercial real estate. I've raised capital for deals. Are you interested in investing in anything with me? Pretty simple and straightforward. There's a difference between commercial and residential real estate when it comes to how you're actually structuring your capital stack. So when it comes to commercial real estate, there's several different ways that you can actually structure your capital stack. You don't have just debt. Typically comes from a local lender and equity, which is either your down payment or what you're raising from investors. You could structure the capital stack creatively as well, where say you've got 50% of the funds to buy this property coming from a traditional lender, you've got 30% of the funds coming from seller financing, and then the remaining 20% comes from your investors. So you don't necessarily have to have any money out of pocket in order to actually get these deals done. Now, these deals are pretty simple to structure when it's just you coming up with the down payment and you're bringing a loan to the table at closing. But let's say you are raising capital from private investors. How do you structure the deal with them? The problem is that's a little complicated. We don't have enough time to dive in that on this video. Check out this one here where I really do a breakdown on how to properly structure this. But at the end of the day, you're probably going to give them somewhere between 50 and 70% equity in the deal, somewhere between an 8% and a 10% preferred return. And that's going to probably end up somewhere between a 12% to 20% annualized cash on cash return by the time the deal is done. All right, now we're headed over to Salt Ranch, which is a boutique hotel that I'm under construction on. Got to check on that and keep filming. So I'll talk about due diligence while we're there. All right, we're here at Salt Ranch, and projects like this do not happen without an amazing support team. I clearly couldn't do all of this work on my own. If we break down just this deal alone, let's talk about some of the entities that have been involved in pulling this one together. The Cobble Group, my commercial real estate brokerage team, helped me find this deal and secure it as a purchase. My commercial property management company, Parasol, helped us manage the property while it was vacant and we were putting our construction plans together. My development team helped pull together all of the vendors and subs that we needed to start pulling together the drawings, the construction plans, our budgets, bids, everything that we needed to actually get this project underway, as well as submitting for permits alongside the contractors and so much more. That's just what commercial real estate is. It takes a team to pull this together. If you're just getting started in the business, you probably can't cheat like I can and have your own brokerage team and have your own property management team and have your own development team. Makes things a little bit easier when I vertically integrated all the companies, but you can go meet companies and teams and individuals that can help you on these deals by going to your local Urban Land Institute meetups, CCIM meetups. You've got a local real estate investors association. Go meet other investors there. There's always going to be architects, contractors, engineers, attorneys. Pretty much everybody that you need is going to be available at these meetups, which is going to make your life significantly easier when you have a team helping you move this along. Now, when it comes to doing your due diligence, you can see there's, of course, a lot of physical inspections that have to take place on a property like this, but looking at the site and looking at the building isn't the only type of analysis that you should be doing. The building that we are standing in right now was built in the 1850s. You can imagine it has probably gone through some environmental concerns over the years, one of which, about 100 years ago, included renovations that had asbestos on it. That is something that we have to figure out in our environmental due diligence. There's also legal due diligence. How does the title look? Are there any issues with the survey? Are there buildings that have been built over the property lines? And that's why I'm giving you my due diligence checklist so that you can actually keep track of everything that you have to have and do it right. All right, you've learned about due diligence, and the final part of due diligence is closing. Once you have gotten through your due diligence, you've satisfied every single question that you have on the property, it's time to actually fund it and buy the property. Closing is relatively simple. If you've ever been through a residential closing, you know that there is a mountain of paperwork. You almost need 4 people that are bringing that in wheelbarrows for you to get the deal done. Commercial, it's actually pretty light because there's a lot of disclosures that you have to sign in residential that you don't have to deal with on the commercial side. So make sure that you have a strong closing company, a really good closing title attorney. That way they have done all of that due diligence on your behalf, and show up. I bring a pen with me, and that's about it. Now here's the thing, we could spend hours and hours talking about how title works and all of the fun stuff behind making sure that you are actually getting clean title and that the transfer of ownership is going smoothly. But if you've got a great closing attorney, they're gonna make sure all of that is good to go on your behalf. The one thing that you really need to pay attention to, there's a lot of things that you need to be paying attention to, but if you're only gonna look at one thing, is the closing statement. Make sure that you understand what is going on with the debits and the credits to both the buyer and the seller as you're going through this. There are a lot of moving parts here, and it doesn't matter how great your closing company is, there will be things that get missed occasionally. I have seen 5 and 6-figure mistakes on these closing statements before, not really because of anybody's fault, it's just there's a lot of things that have to be accounted for when you get to this point of the process. So review those closing statements. All right, congratulations, now you own the property. It's time for the real work to begin. And you're probably thinking, I just went through a mountain of work to get to this point. What do you mean that the real work begins? Well, once you actually own the property is when you have to start working on creating all the value add. You just get to think about it, dream about it on the front end. But now it's actually time to put pencil to paper, get that contractor out there, redo all the spaces, start changing up the leases, finding new tenants, all of the fun stuff. But here's the thing, you don't have to do it on your own. Like we mentioned earlier, get your team. Make sure that you have a phenomenal team that is helping you through this entire process. And that can include a broker at this point that's handling all of the leasing for you. That could include a property manager that is managing the day-to-day of the asset on your behalf, a general contractor that is handling everything that needs to happen from a construction standpoint. And those 3 people just report to you as the property owner. That way you're not responsible for every single thing. That's the only way to set it up if you're going to truly scale this. So how long does this process take? About 9 months. I work with a lot of students in my commercial real estate mastermind where we dive into how to get your first deal. The first 30 days is almost all underwriting and looking at deals. You have to familiarize yourself with the market and what is available in your area and how do deals look? What is the vacancy rate? What are spaces renting for? How much is an industrial flex building on a cost per square foot basis? That's all stuff that you're really nailing down in the first 30 days. The next 60 days is really working to find the actual property that you're going to buy, putting it under contract, and starting your due diligence. Due diligence, that'll take anywhere from 60 to 120 days, or sometimes longer, depending on what you're looking to do. On average, my students will close their first deal in about 9 months, and so should you. So a couple of final parting words of advice. Don't underestimate the costs because these projects tend to go over a little bit. Don't get over leveraged. I know it's very tempting to put as much debt on a property as you possibly can and not come out of pocket, but I gotta tell you, the more equity you have in a deal, the safer you are, because the banks are not gonna call deals that have a 50-50 loan to value. There's just not a lot there that puts them at risk. And of course, don't trust the wrong people. Don't get into bed with people that you haven't vetted just because you wanna get your first deal done. Take your time. Do not rush through the process. Commercial real estate is a long-term game. It is a marathon, so prepare for that. So like I said at the beginning, commercial real estate is not easy. It's a lot of work, but it is very simple if you have the right step-by-step process. And if you want to get that ultimate deal analysis toolkit, again, totally free. It's going to help you do your first deal, do everything. Scan that QR code right there.